Welcome everyone. Hope you all had a wonderful weekend. Thanks so much for logging in to tonight's session on swing trading stocks. As usual, the disclaimer comes first. Trading carries a high level of risk. You're subject to lose all or more of your original investment, so don't trade with money you can't afford to lose or money that if lost would affect your current lifestyle. The information in the presentation is for educational purposes only and is not intended to be financial advice. The purpose of this webinar is to help you better understand the markets and improve your skills as a trader. I believe a balanced life leads to a healthy life, and our attitudes influence our behavior. Trading is a small but meaningful part of the bigger picture. Again, thanks everyone for logging in, and if you're watching the recorded webinar, thanks so much for checking it out. Tonight's topic, a little bit different, and I had some requests to do a webinar on swing trading. So tonight's topic will be about swing trading stocks, the methodology, the philosophy, and the principles that we'll talk about. Even some of the entries and exits can be translated over to the futures markets. And there's a lot of things that do correlate really nicely as far as the fundamentals in the sense of the mindset that carries over. Now, I started out trading stocks. That's how I got involved in the stock market in the first place. And then I kind of migrated from stocks over to options, and then eventually where I am now, day trading futures. And when I first began, I really wasn't set on day trading. I wasn't going into trading with the mindset that I'd like to become a day trader. It's something that kind of evolved over time, but I'm really glad that I began with stocks and with swing trading in particular. It did a couple of things for me, and I found it really helpful, and it kind of built a nice foundation for me to then build off of, so to speak. It planted the foundation. So, swing trading, it can really help build the mindset of simple is better. And another benefit is that it's not as time consuming in the sense that you're not glued to the computer screen during the intraday sessions for the markets. A lot of the analysis and things can be done outside of market hours. You can be more objective. You can spend the time researching and doing your watch lists and scans and things like that in a clear mindset without any distractions, because you have the freedom to kind of pick and choose when you want to go through and do your analysis. You're not forced to be sitting in front of the screen all day. So with that said, we'll just kind of get to the outline for this evening, and there's a lot of stuff that I want to get into the webinar. So we'll go through some of the basics, obviously, as we always do. We'll talk about the methodology that I use in particular, and obviously there's a plethora of different methodologies for swing trading, longer-term investing, but we're just going to touch on the methodology that I use as far as swing trading, that is, holding overnight positions in various stocks. We'll go through some of the entries and setups that you can use. We'll talk about stop placement, some tricks for calculating position size, a handful of you probably already familiar with, but we'll go through some examples there. We'll talk about setting profit targets, similarly to how we do with the intraday on the ES and the 6E. I'll show you how I set up my scans and the watch list criteria that I use, and I'll show you how I place my orders using the thinkorswim platform. Most platforms have all the same capabilities, so regardless of what platform you use, you should be able to set up your orders the same way. And you can get everything set up while the market's closed the prior evening, and even to the point where your orders will be executed for you at a specific time of the day, if you'd like. So that's kind of the outline for tonight. We'll look at some charts. We'll talk about some of the methodology and the philosophy behind it, and I think that there will be a lot that you'll be able to carry over to day trading, and whether you swing trade already, whether you've never swing traded, or whether you don't care anything about swing trading, I think there's a lot of principles and even some techniques that you may find helpful, and I found helpful, that I was able to apply then to the smaller time frames. So as you get to the bigger time frames, as you zoom out, things slow down a little bit. A daily bar takes, a daily bar takes hours to form, whereas a 15-minute bar takes minutes to form. So, forcing yourself to execute trades off of a daily time frame can really help improve your patience and discipline. And I know that's one thing that it really helped with me in particular. So before we begin, I just wanted to read a quote from Jesse Livermore, and that is, "The fruits of your success will be in direct ratio to the honesty and sincerity of your effort in keeping your own records, doing your own thinking, and reaching your own conclusions. The average man doesn't wish to be told that it is a bull or bear market. What he desires is to be told specifically which particular stock to buy or sell. He wants to get something for nothing. He does not wish to work. He does not even wish to have to think." I really like this quote, and it may seem a little bit counterintuitive in some sense, but I think it's really important to, with all the information out there and with all of the systems and different methodologies and things like that, different traders talking about, promoting, especially on the internet, it's important to do your own thinking and realize that you can come up with, some of the very best observations by doing your own analysis. And you'll have the most conviction if you do your own analysis. So while I enjoy educating and talking about what I do in the trading realm, you've probably noticed that I don't put a whole lot out there about different opinions that I hold, longer term views, specifics to different stocks that I'm getting in and out of, different viewpoints that I have on the ES and the 6E. Every once in a while I'll kind of share my views and share my opinions, but the purpose of not going in too depth is to really try and help you guys create your own opinions, give you some tools that I use, give you some of the knowledge that I share, some of the knowledge that I have, and then allows you to kind of go about and create your own methodology and create your own framework and be able to execute your trades on your own without the need or the crutch of having someone else there that you have to rely on, that you feel like, I can't make a trade without listening to Tim. So I think it's really important to do your own thinking. At the same time, listening to others and reaching out, pulling from other people out there can be a good way to bring in information, but sorting it on your own is, I think, the best route to go. So let's go into some of the basics. And with swing trading, obviously there's all sorts of methods, but I prefer to begin with identifying trending stocks, stocks that really the goal of swing trading stocks is to capture larger moves and longer, in the sense of longer term than intraday. The goal is to, on some fundamental level, be entering positions that will last on the terms of a week to maybe even a couple months if you're able to trail your stops and things like that. But it all begins with identifying trending stocks. And we do that by looking at the daily charts. And I only look at daily charts when I'm looking at swing trading. And it kind of simplifies things a little bit more, but it also helps keep a clear perspective and not get chopped up in some of the noise that is the intraday. And I'm also looking at some of the candlestick formations and the patterns, whereas with the ES and the 6E, when I'm using the Heikin-Ashi candlestick, I'm not really focused on the actual formation that the candlestick makes, but on the on the daily charts, when swing trading, I am paying attention to the candlestick formations and what patterns that they're forming. And the nice thing is, while the ES and 6E, you're constrained to those two markets if you trade those two markets. If you swing trade, you have the ability to trade a host of different stocks from different industry groups, different sectors. So the ability to diversify in that area and really only search for, as we would intraday, search for the cleanest setup, the best setups, not taking every little micro setup, just waiting for the best ones, that are visible on perhaps the 15-minute time frame, not getting chopped up into smaller time frames. Well, with swing trading, if stock A doesn't have a clean setup, well, then you can move to stock B. And if stock B doesn't have a clean setup, you move to stock C, and there's thousands of stocks out there. So it's really to your advantage to take a list of 500 and narrow it down to 5. And I'll show you how I do that in a couple slides. So getting to the methodology and the indicators, as you know, I'm not big on indicators, so it probably doesn't surprise you that I'm simply just looking at price and volume. And really, that's all you need. And again, the larger the time frame, the slower things develop. So the less information is even more of a benefit. While you have more time to do fundamental analysis, technical analysis, go through a lot of different analysis, if you will, in all different respects. I think keeping it strictly to price and volume and the technical aspects is really what makes swing trading, at least my style, so effective. And it comes down to looking at relative strength and relative weakness, and looking at the broader markets, so the S&P, the Dow, the NASDAQ, and the Russell, and looking at how do the stocks react relative to those indices. So we're looking to buy relative strength and sell relative weakness. So what is relative strength? If we take a look at the SPY, we do that because then we have the volume as well. The SPY, DIA, QQQ, and IWM. I give you volume for those adjacent indices. And in doing so, we can do some quick analysis, whether you do fundamental or technical. I do technical, and just simply looking at the general trend of the S&P. And we've kind of been chopping around sideways. It's been pretty clear that for the past 2 or 3 months we really haven't gone anywhere. But the last 2 weeks or so, we've been in this nice little downtrend here, and we were kind of bouncing off this support level here, and so you can kind of see where we touched, consolidated back here in February. Then we started drifting higher, but then we kind of drifted back down, and that resistance back here became new support over here. And we drifted a little bit higher, and then we came back down, and now we're bouncing back down here again at this old resistance point. So the way relative strength works is when I'm looking at individual stocks to buy, well, I'm looking at stocks that are relatively stronger than the S&P. So an example here, ADM. Back when the S&P is moving down, what is ADM doing? ADM is moving up. And if we look at the volume, it's moving up on stronger volume than it's pulling back at. So we had an earnings announcements back here beginning of May, moved up on strong volume, but then it began to pull back. But what did the volume do? The volume sold off, or the volume declined. And then we had another strong up day, and this would be what was known as a bullish engulfing pattern right here. And what did the volume do? Volume surged upward. So we've had periods of increasing volume, for instance, back here, as price was moving higher, volume was also moving higher. And Gary asks, do I use fibs on the stocks? And I do not. I mean, I have thrown up halfway backs and things like that, but for the way I trade on the swing trading time frames, I don't use fibs for execution, or at least the halfway back. I found that the halfway backs work the best with the multi-item markets, meaning markets that have multiple stocks encompassed within. So you, like, for instance, the indices, the ES and the Dow. You have multiple stocks within that. The ETFs, the currencies, I found those are the best markets to use that specific halfway back methodology. So while that's simple in itself, the swing trading methodology that I use is even simpler, if you can imagine that. So that's relative strength. If we flip over then to relative weakness, again, taking a look at the S&P, and the S&P today down 1.1%. And if we look at specific stock CDE, CDE was down over 4%, and we have increasing volume as the stock is selling off. So again, the stock is selling off and the volume increasing. These moves higher, these moves lower are adjacent to large volume, and the moves higher, the little bounces in between, have smaller volume. So that's a sign of relative weakness. So on the next bounce, or the prior bounce as we just had here back 2 days ago, would be an opportunity to short into the small amount of strength that we had. So that's relative strength and relative weakness, and that's really a good gauge of the beta of a stock, meaning how much does each stock move relative to the indices. So some of the entries and setups that you can use, there's really two primary that I have that I use. And the first one is just a simple breakout entry. And what we have is a little consolidation period, and you're simply looking to, when you're going long, to buy over the high of that consolidation period, and if you were going short, to short underneath the low. We'll go into each of these in a little bit more detail. Then the second entry is the pullback entry, and the way that works is you're simply buying pullbacks on strong stocks in an uptrend and shorting rallies on weak stocks in the downtrend. So where instead of waiting for the actual breakout above highs, the pullback is comes a little bit sooner, but it's in anticipation of the continued trend higher. So all of these little pullbacks that we've had here in the particular example, are opportunities to get into the trend. And the question is, stop in the breakout is a little bit wider. It depends. We'll go through some of the specific stop placements that you can use. And if you adjust your position size correctly, whether you're using a 5-point stop or a 20-point stop, your risk will be the same. So we'll get into that in a couple slides, I believe. So the breakout entry for longs, we're looking to buy over that consolidation level, and it's simply just placing a buy stop a few cents above the highs. You can use a penny for stocks $75, $100. You may want to use 5 or 10 cents, give it a little bit of room, but really that's the general principle behind it. Just letting the market tell you when it's ready to go higher by using a buy stop over the highs. And then for shorts, you just flip it around. You have a short below the consolidation level, and you're just using a sell stop a few cents below lows. Now with shorts, Well, with longs, obviously the stock can, go to infinity. With shorts, the stock can only go to 0. So I like to keep my shorts with stocks above $15 just to give me a little bit of room as far as risk to reward goes. And then for the pullback entry, what I like to do is buy over the high of the low bar in an uptrend. So you'll notice that, for instance, this bar is the low at this point. This bar is the low in this uptrend. And so buying over the high of this low bar I found to work really well. And then for shorts, you're just shorting below the low of the high bar. So you just take the chart and flip it upside down. So high of the low bar, low of the high bar. Those two methods, I've played around with that actually with the euro as well on a 5-minute chart. And it can be fairly profitable. It's, buying over the high of a specific bar on a little bit smaller time frame with the intraday charts is a method that Al Brooks has used in the past. I know a couple of people are familiar with some of his work. And yeah, the ES, 6E, all the currencies and things like that. The high to low bar, low high bar is a strategy that can be transposed rather easily to different time frames, and breakouts as well. So that brings us to stop placement. And with the initial stop, I'll use 10 to 20 cents depending on the price of the stock, and we'll just put it 10 to 20 cents above a swing high if I'm shorting and below a swing low if I'm going long. So if I was going along above this consolidation level or above this consolidation level here, just placing the stop below the little swing low here or below this swing low is a great line in the sand. And the nice thing about daily charts is they're very clean cut, meaning you have a specific price that you can draw your line in the sand, your failure point. Similar to how we use the 61.8 for the failure point on the ES and the 6E. Using prior swing lows can be really a clean level where a lot of other traders might be looking at to short. So you, as someone going long, it's a great opportunity to place a stop, and I like to give it just a little bit of room. So, 10, 20 cents, 30 cents if it's a $100, $150 stock. But just giving a little bit of room is important. And then when you're using trail stops, again, you can trail your stop underneath each consolidation level as the stock begins to move in your favor. So in this case, if you place your initial stop down here into this consolidation level, once you get a little short burst up into the next, whether it's a bull flag or just some kind of basing period, you can move your stop underneath that swing low. You can also put it under the previous daily bar. So if we're moving up really fast, for instance, this big body candle right here, you could move your stop underneath that candle. And if we have a series of days where we're moving up really, really fast, you can continue to do that. Now, you'll get taken out of the trade more often for a profit if you're trailing your stop like this. But the trail stop will get hit a little more often because, as you notice, what happens here, moving up rather quickly, in a matter of a couple days, but then we do get a little bit of a pullback where we've broken the prior day's low. So it's something that works well if you get a quick burst, but I always like to allow the trade to pull back a little bit. One thing you could do is draw from lows to highs and put your stop underneath the 61.8, as Gary was talking about doing with the fib tool. But I like to let it pull back just a little bit to form that next swing low, and then I can move my stop up, just as I would with the 6E. Not trailing too tight, but allowing it to form, allowing it to come back into the next halfway back, and then putting my stop underneath that 61.8 or that swing low. So allowing the swing level to form is the importance there. As far as calculating shares and the number of the position size goes, really simple formula. Just take your risk amount and divide that by the difference between the entry and stop. So an example of that, if you have a $50,000 account and you are comfortable risking 1% of your account per trade, very simply comes to $500 risk per trade. And for this example, if we had an entry of 48.80 just above the swing, the high here, what was the high, and the low of this consolidation was at about 47.30, so we'll throw a stop at 47.20. The difference between that is $1.60, so $1.60 into 500 is approximately 312 shares. Oops. And that will allow for $500 risk on this trade. You take a different stock with a different entry and a different stop, and you plug in those numbers pertaining to that particular stock, and you get a different number of shares, but that will allow for the same risk amount. So a lot of people ask, well, how many shares should I trade? Well, it's really not about the number of shares, but it's about the risk amount. So you can use that really simple calculation. When you get into options, it gets a lot trickier. Yes, with 312 shares, you would be looking at, with a $50 stock, about $15,000 of capital requirement. And if you are on margin, that'd be $7,500. With an option position, less capital would be required, but then there's a whole host of other factors in the Greeks, in the time decay, in the volatility that will all factor in. So for that reason, I do really enjoy the simplicity of trading stocks, and for that reason, it's very easy to manage your risk. Whereas an option position, you may theoretically have a risk amount of the entire option contract, whether or not your plan is to let it expire worthless, or if you have a cutoff point. There's so many other variables that end up going into it with the theta, vega, gamma, and all the other Greeks that it can become a little bit hard to trade, in the sense that the stock can move in your favor in the direction you had thought of, in the direction your analysis told you it would, but you still lost on the trade. So you have to be not only precise with the direction when you trade options, if you're doing directional options, calls and puts, I should say, but you also need to be right on with the timing. And that can be something that's more of a challenge. So moving over to profit targets, and the question of, well, will we use an arbitrary stop versus trailing? And as you would probably guess, my vote would be trailing my stop, because especially with stocks, they can always go higher. So in the past, I've looked at the negative 23% target, the negative 61.8% target, to put an arbitrary profit target limit order at. But what I found is, yes, you get your profit target hit, and it pulls back, and you think, awesome, I got it, got it near highs. But what does it then do? It just continues after the pullback to go a little higher, and then a little higher yet again. So what I found over the years is that just trailing my stop underneath the prior swing low for longs and above the prior swing high for shorts is really the best way to stay in the trade for the longest amount of time, and take the most amount of profit out of the trade. So again, back to that example, just putting your stop underneath each consolidation level as we go higher. And once we break that consolidation level, boom, you get taken out of the trade and you move on to the next. And with this methodology, you can put a position on today, and you're simply managing the trade in the sense that you're trailing the stop underneath each consolidation level, and that trade could go on for a period of months if it's in a strong trend, if the market is moving really nicely. And the other benefit with swing trading and day trading is when the market's moving up or down very strong and we're trending, but not in the sense that intraday markets are trending, meaning as we've had in the first portion of 2012, a lot of gaps and a lot of moves that were not as easy to get into on the intraday time frames. These positions you're already in on the daily levels. So it's great to be able to enter at a daily level at halfway back, but it's not something that happens every week. So to have a balance of swing trading positions, and then when the broader market goes into a sideways position, volatility kicks up, that's when the day trading really begins to spike. And then, that's an area of diversification. You have strong trending markets with big profits coming in swing trades, and then you have, VIX volatility index of 25 to 35 when you're just killing it intraday, and it really makes for a nice balance between the two. And then the way to diversify with stocks, you might ask, Mike asks here about diversifying the individual stock positions. Well, I diversify by going long and short. So I let the market tell me which stocks are relatively strong and relatively weak, and then by having positions on in both, the market can go up, but since the shorts that I'm taking are relatively weak, they may still go down, and vice versa with the long positions. So just a few more ideas for trailing. With longs, below the prior day's swing low, and below the prior swing low. So again, the actual daily bar, the day's low, or what I prefer here is the actual consolidation low. And another major support level that ends up becoming visible sometimes are when we have this resistance point where 1, 2, 3 times we've knocked our head, that resistance now becomes support. And for shorts, again, it's just the vice versa. Above prior day's high, above the prior swing high, or above a major resistance level. So moving over to the scans and watch list setup that I use a website called FinViz. It's just a free scanning website. Most charting packages have scans, but all I do is I just set the scan for new highs and new lows. And again, I was using stocks over $15 for lows. Sometimes the new highs will pull in stocks that are, penny stocks or down at $2, $3, and usually I just end up tossing those out. Once in a while there will be, a gem within the bunch, but for the most part, that's where I begin with the new highs and new lows, and I just dump those into Excel. Each night I just have the scan as a favorite in my bookmark, dump it into Excel, and then I keep the running list, and you just filter out the duplicates and then go through, and that allows you to have a nice basket or a running list that you can use, and after a couple weeks you'll have a nice stock list to pick from. So from there, once you have a basket of stocks that you can use, and again, this is an ongoing, every day, going in and just adding the new 52-week highs and lows to the list, and then filtering out the crummy ones from the selection. So I'll begin on a weekly time chart, and I like to see the weekly chart near all-time highs. I don't want a weekly chart that's in a downtrend. I really put a lot of weight on this factor, so I'll just dump stocks that are not at new highs. And then for longs, looking for strong volume on the rallies and weaker volume on the decline, and that's the weekly charts and the daily charts will be similar to that. And the shorts, again, vice versa, strong volume on a sell-off, but then weaker volume on a bounce. Looking for that basing pattern, that consolidation pattern that we were talking about earlier, and then those clear support and resistance levels. When you go through 500 stocks in an evening, over a couple of weeks, a couple of months, a couple of years, it'll really become easy to quickly identify good stocks versus bad stocks, and you'll just know instantly by looking at the chart. So I can go through 500 stocks, in a matter of 20 minutes, just because it only takes a few seconds of looking at each stock, each chart, to kind of get a sense of, okay, it's a clean pattern, it's a nice consolidation formation, we don't have a lot of gaps all over the place, and the chart is setting up how I like. So for those that are on Thinkorswim, I'll just touch briefly on how you can place orders. Like I said, most charting packages have similar options configuration of these options. But with Thinkorswim, you just go to the Trade tab, punch in the symbol, and click the Ask or Bid, whether you want to buy or sell. And then you can do a first trigger sequence. So you would click the Ask, you would pull up a buy, and you click the Bid, it'd pull up a sell, put in the number of shares, and then if in this case this would be a long order, you're going to buy first, and the sell is going to be the stop. So it's just a market stop, a buy stop, and you put in the price that you want to use as your trigger point, and then you put in your stop and the price you want to use as your trigger point. I also changed this to GTC, good till canceled. That means the stop is in there at all times, and then you can simply, as each day goes by or as each opportunity for tightening your stop, you can just go down to your working order box, right click, and just update the stop price that you want to use. And then the second order, if you do want to use a limit, an arbitrary target, you just do first triggers OCO. So same thing, you click the Ask, click the Bid twice this time. That puts two sell orders in. The first one is your stop, and then the second one is your limit order. That way, once you're filled, then as soon as either the stop or the limit order gets hit, the other one will cancel. Pretty simple. Again, good till canceled on the orders for stop and limit. The actual execution, the entry, I just leave that as a day. And then finally, a cool little thing that you can do in Thinkorswim, I like to wait for the first 15 minutes to go by before placing a stock order or making any decisions on swing trading. So while I wait 30 minutes on the ES, I also found value in waiting not 30 minutes but 15 for the swing trading. And what you can do is if you click this little sprocket down here on your entry price, your entry order, you can go ahead and check the box that says submit order at specific moment, and then you just change that to 8:45 Central Time. Just change it to 15 minutes after the market opens, the NYSE cash session, and that'll wait 15 minutes before sending that order. So with the ES, I wait 30 minutes. I wait for the first 30 minutes before placing a trade in the ES, but with swing trading, I wait the first 15 minutes. So that's a nice little feature you can use if you have a handful of orders open, if you're managing a trade in the euro and you don't want to be messing with the swing trading. It's pretty much hands off as it is. You can get everything set up the night before, get all your orders placed, and then it's just a matter of, is the market going to fill me or is it not? If it does, great. My stop orders go in, just like with the Infinity platform. It sends out the bracket order, boom, everything's in place. With the swing trading, you either get filled and your stops go in, or you don't get filled and the order cancels at the end of the day. So that's the way that I place my orders in Thinkorswim, and like I said, most platforms have similar capabilities. A few other things to note before we wrap up here. I don't trade earnings. I don't like to kind of gamble around earnings. So if I'm in a position, I'll typically close out a good portion of it before earnings. And you'll have 3 or 4 months between earnings announcements, so it's not something that happens regularly. But around earnings announcements, it's important to make sure you're not placing a trade right before an earnings announcement. And I'll usually, a week before earnings announcements, I won't look to trade that stock just because it can become irrational relative to the technical trade that might be setting up. Now, as far as gaps go, you say, okay, well, I like trading intraday because I don't have to worry about gapping. Gapping overnight, gapping in the morning, the position going against me, taking a huge hit when the market opens. So for gaps, as I said, the first 15 minutes, I won't do anything. So it's really important to stay calm. You're in a long position, the gap's down. Wait 15 minutes before doing anything, making any rational, making any decisions, because when your emotions get involved, that's when you do irrational things. And what I like to do is simply place my stop above or below the first 15-minute candle, or after the first 15 minutes occur. If I'm long and we had a gap down, I just put my stop underneath that 15-minute candle. And most times, at least more often than not, that can end up being the low for the day. And this gap down is just, whether the broader market gap down or if there's something else going on, that's all the cause. Now, if the broader market is strong, going back to that relative strength, relative weakness, but my stock that I'm long of gap down, then I would be a little bit concerned. But again, placing my stop underneath the first 15-minute bar, or after the first 15 minutes have traded, just put your stop underneath that low, and that'll at least keep you in the trade if it was just a false alarm, but it will take you out if there was some substance to that move and that gap in itself. A couple good books on the subject. This one, How I Made $2 Million in the Stock Market, by Nicholas Darvis, is actually one that I had just come across in the past 8 months or so. But as I was reading through it, there were so many times where I was pulling things that I had made notes of over the years. I had made comments about in my own trades. And so I think for a newer trader or even a veteran trader, there's a lot of good nuggets in that book. A little bit corny in the title, regardless of his method that he uses, there's a lot of good nuggets of wisdom in there. Some things you can pull out and apply both to swing trading and day trading, and it's a good read. It reads more like a novel than a nonfiction textbook, if you will. And then Market Wizards is the last book that I think is really valuable to those who are interested in getting more out of swing trading. Jack D. Schwager is the author of those. And the Market Wizards, while the ES and the E-minis and the 6E haven't been around for that long in terms of, the last couple of decades, some of the Market Wizards in here have been around for, that Jack talks to, have been around, the market since really the Great Depression, and have been through some of that stuff. And, there have been trading stocks, swing trading, day trading, swing trading futures. There's a lot of good nuggets of wisdom in there as well. So those are just a couple of things to note. Yeah, so that's about it. I like to keep it really simple, and as you can see, almost too simple in a sense, but simple is better, and there's a lot of value in the ability to get in a position and with a defined stop, a defined entry, and a defined stop, so you can really manage your risk to the extent that obviously you can't control gaps, but it's very rare that I have a stock gap against me in the overnight session that has done any substantial damage. I mean, I've never had that happen. As a matter of fact, just doing things like staying away from earnings and trading simple, just the very simple consolidation patterns. And yeah, you get into some of these positions, and next thing you know, a month goes by, and you've detached yourself from the position. You're extremely patient, and it's just a matter of trailing your stop and staying in for as long as possible. When we do get these big bear runs in the market, these big bull runs in the market, when the volatility, especially in the bull runs, sometimes the volatility can slump down and sink way down. So intraday, the ES might only have a range of 10 points. Well, some of these stocks can kind of make up for some of that lack of range, lack of volatility on the intraday markets, and it can help keep you patient, knowing that, well, I've got longer term positions on that are going in my favor. Again, I don't have to make a trade today, so I'm just going to continue to wait for the best setups on the intraday time frame. So that's all I have on swing trading stocks. I tried to touch on as much as I could as far as the details of my setups and the way I go through my scans and things like that. But I think the most important thing to take away is doing your own analysis. These would really be the only two things I would recommend paying for. If you could find the books at the library, awesome. Otherwise, a couple bucks on Amazon, and that's a great investment in your trading education. So I hope everyone has a wonderful evening. Thanks again for tuning in.